Joining us now is finance professor Rebel Cole from Florida Atlantic University. Professor, how would you explain this banking failure to those who don't understand how something like this could happen?
Silicon Valley Bank was a unicorn of sorts. Its loans were concentrated in one industry, which was startup tech firms. Its securities were concentrated in very long-term government securities, and its deposits were almost entirely in excess of the $250,000 limit on deposit insurance. So they were uninsured. More than 90% of the deposits were uninsured. What has happened is over the past year, as interest rates rose, the bond portfolio lost value. Bond values moved in the opposite direction of interest rate. So this bank had about $17 billion in unbooked losses on its bond portfolio, which was in excess of its capital. But it was in we call the held to maturity portfolio that doesn't get marked to market by regulators. So it wasn't forced to actually write those down. Well, on Thursday, the bank announced it was going to raise capital to shore up its balance sheet. And the uninsured depositors got scared, and we call it a bank run. So they started pulling their deposits out. And they pulled out their deposits in an incredible speed we've never seen before in the history of banking, because technology is such that everybody can bank on their phones. People just get in on their phone and doing the withdrawals. $42 billion were withdrawn on Thursday alone. That's 20% of the 200 billion deposits in the bank. So this was going to continue on Friday. Normally, the regulators will close a bank after 5 p.m. And then on a Friday and reopen it on Monday. It was so bad the regulators had to step in and close the bank during the day on Friday.
After SVB, we saw what happened with Signature Bank. Do you think the public has been reassured enough to stop this panic and domino effect?
Signature Bank had similar issues. They weren't lending into tech, but they had the same issue with unbooked bond losses and uninsured deposits. The deposit run began on Friday, and regulators had to step in over the weekend and close it. So what happens is when people see a problem with one bank, it's what I call there's never just one cockroach. They think, okay, there are other banks that have similar problems. In total, I think they estimate that there's about $600 billion in unbooked losses in the U.S. banking sector, and it's concentrated in a few companies. But it's really the ones that also have these uninsured deposits. So any bank that had large unbooked losses and had a lot of uninsured depositors was at risk of contagion. Signature Bank, that First Republic Bank in California, is also under stress, and I would not be surprised to just get closed today or tomorrow. And there's a handful of other ones. There's probably less than 10.
So more bank closures is what you foresee happening within the next few days?
Yes, I very much do. I don't think it's going to be many, maybe half a dozen. Maybe as few as one or two, but I do think there will be at least one or two additional bank closures in the next couple of days. These are large banks, but they're not viewed as systemic banks. In other words, the failure of these banks is not going to cause the whole financial system to collapse like it almost did in 2008.
Thanks so much for joining us, Professor.
It's been my pleasure.